to this webinar on mobilizing private sector capital for sustainable and resilient supply chains. And this is brought to you by Revenues for Nature, an initiative led by the Green Finance Institute, UNDP Biofin, and UNEP FI. My name is Tom Williams. I'm an Associate Director at GFI, and I will be your moderator for today's session. Before we get into the agenda, let's just cover off some housekeeping on the next slide. We do have interpretation available for today's webinar, so we'll be mainly conducting it in English, but if you would like the Portuguese or the Spanish interpretation, then you can click at the bottom of your Zoom bar. At the moment, I see a more option, and then you can go to interpretation, which is marked by a globe, so hopefully you can find that. So again, just to repeat, you should be able to find it at the bottom of your Zoom, either directly on the interpretation tab or go to more, and you should be able to find that. Any issues with the interpretation, please do use the Q&A, and we'll make sure that we can resolve those. We will have time towards the end of the webinar today to take questions from the audience. So if you have questions specifically for any of our speakers or more generally, do put those in the Q&A panel that you'll again see at the bottom of the Zoom panel, and we'll get towards them at the end of the session. We will be recording this session, as you probably heard, and also sharing the slides. We'll plan to do that in about 48 hours' time. So on to the agenda. I will spend a couple more minutes framing the Revenues for Nature programme and also today's topic. I'll then provide some further detail about a new guidebook that we are launching today on the Living Amazon mechanism. We will then move into our case studies, and we have 4 excellent cases to share with you, focusing on different supply chains in different geographies. We'll then have an opportunity to have some questions and answers with the speakers, so do encourage you as we move through the presentations to put any questions that you have in that Q&A box. Then I'll close off in about 80 minutes' time. So a bit of background and context for today's session. Revenues for Nature is a joint initiative, as I mentioned earlier, from GFI, UNDP Biofin, and UNEP FI. It was launched in early 2024, which and it aims to identify, replicate, and scale nature-based revenue models that attract private sector finance to nature restoration and nature-based solutions. So really what we're looking at here are models such as payments for ecosystem services. We're looking at habitat banking, biodiversity credits, supply chain financing, which we're looking at today, for example. And we were really excited last week to announce our support for 7 models across the globe that are working on these different models, a few of which we have with us today, including LENS, the Landscape Enterprise Networks, Rimba Collective, the Living Amazon mechanism, and the Fishery Improvement Funds. A big part of the Revenues for Nature initiative is bringing together a diverse group of stakeholders, so from government, private sector, NGOs, into so-called communities of practice to exchange knowledge and ideas. And this is where today's webinar, which is a series of webinars, fits into Revenues for Nature. And lastly, we publish a range of case studies and guidebooks to provide much more detailed information about these models, which aim to support their replication and scaling. And I'll have more about one of these guidebooks in a moment. And this brings us back to today's discussion on supply chains. A number of the models I just mentioned are focused on nature-related interventions in corporate supply chains, with agricultural supply chains being a significant one. We're all aware of the significant impacts and dependencies that agriculture supply chains have on nature and also climate, as it relates to GHG emissions and sequestration, for example. So the opportunity space is significant for nature-based revenue models in corporate supply chains, and corporates are becoming more strategic and systemized in their investments, driven by regulatory drivers, disclosure frameworks like TNFD, climate targets, the emerging nature targets, for example. And we are seeing many corporates make big commitments to invest in their supply chains. So today we're going to look at the kind of revenue models that are responding to this opportunity. Before we move on to our speakers, really pleased to announce today our latest guidebook, which will be focusing on the Living Amazon mechanism. This will be published and available later this week, and we're delighted to have the team behind the mechanism with us today, and they will go through this in much more detail soon. But what this guidebook aims to do is really spotlight the Living Amazon mechanism, and this is a pioneering financing model that channels commercial and concessional capital into socio-biodiversity value chains across the Brazilian Amazon, really seeking to empower local communities whilst also advancing sustainable finance. Within the guidebook, there's actionable recommendations and lessons learned. And really what the guidebook tries to do is to position the Living Amazon mechanism as a replicable mechanism that can mobilize capital for nature-based solutions that help deliver on Target 19 of the Kunming-Montreal Global Biodiversity Framework, and at the same time advancing an inclusive and regenerative business model. As I said, we will hear from the team behind this in a moment so that we have a bit more detail about the structure, the scope, the instruments and impact of the mechanism. In the follow-up to this webinar, as I mentioned earlier, we will share the recordings and the slides, and we will also share a link to this guidebook. Okay, with that, let's move on to our speakers. As I mentioned, we've got 4 cases lined up. And as I mentioned, we're delighted that we have the LAM team with us to dive more deeply into this mechanism. We have Gabriela, Manuela, and Victoria. And I think, Gabriela, I'm going to hand over to you to take us through the Living Amazon mechanism. So over to you, Gabriela.
Thanks, Tom. So yes, I think we have some slides here. Also, I'll present a bit, and as Tom said, you can find more information on the guidebook, and we are happy also to address the questions at the end. So basically, I think just to give you an overview, I work at Natura. Natura is a cosmetics and personal care company, Brazilian company, multinational. And of course, being a Brazilian cosmetics company, the Amazon is a very important region for Natura. And Natura has around 55 years. And it started working 25 years ago in the Amazon region. And it started working in this model with the communities. So our supply chains in the Amazon, we call social biodiversity supply chains. They provide us with nuts, they provide us with seeds, also with more elaborated materials, with more added values, so butter and oils already processed at the community level. And we also always worked with associations and cooperatives at the community level. And this experience of 25 years working with the communities, we noticed many challenges that are recurrent for them. And one of them is credit, access to credit, how they have working capital actually to finance their annual crops, so to purchase from the family farmers and the plant extractivists. So how they have this financial resource to actually run their operations. So this has been one of the barriers, and the others are all the structural elements to actually have a supply chain in the Amazon. It involves logistics, it involves actually capacity building for organizational matters, how you strengthen these cooperatives and associations in their governance, how to address gender inequalities, how do you onboard the youth, actually involve them. We have this issue of rural communities, actually people live in the rural communities and going to cities. So many challenges. And Natura started conceiving already in 2011, and it was working already at that time and looking at the strategy that we should have actually a mechanism to channel resources and partner with other organizations to strengthen these supply chains. So I think it's also very important to say that these supply chains, and here is this group community of practice is also very much related to nature, and not only the challenges that these organizations and communities were facing, but also the challenges that the Amazon is also facing. So we partnered with VERT and Pumbio. I think we can move to the next slide. Into 2022 to start conceiving this mechanism. So we came up with this structure. VERT is a securitization company in Brazil. Victoria is here. She can address more specific questions later. And also with Fumbio, which is the Brazilian Biodiversity Fund, and is very much specialized in channeling resources to philanthropic resources to nature conservation and nature protection in Brazil, biodiversity protection. So we partnered with them and we started conceiving how this would look like, how this is structured, that we would provide credit, but we would also provide philanthropic investments together in a blended finance model to the communities. And I think it's very important, and Manuela from Fumbio highlighted this yesterday, to say that one key feature of this mechanism is that we do all together with the communities. So we have ongoing consultations. They are also on our governance board. We have a board that takes the decisions. So we have the investors, we have the communities together, and we craft this mechanism further with the support from the communities. Also, how we design this instrument, the credit instrument, the agricultural receivable certificate, we also listen to them. When were the times in the year that they needed these financial resources, how would fit better to pay back. And I think the guidebook will focus on this pilot phase, the first year, and we had 0 default rates. So it's very interesting how we shape this, and is also based, their capacity to pay back is based on how there is a forecast of how much Natura is going to purchase, and this is how we shaped it. So it starts with Natura supply chain, so the cooperatives and associations that Natura has been working, because as I said, the logic behind the credit instrument is very much this one of seeing what's the forecast and actually landing to this limit so that they are also not in a situation of indebtedness. And it was a very interesting learning process and how we adapt traditional market instruments and to this reality. So simplifying contracts, accessible language, not legal language per se, but actually translating this to accessible language. And also in the philanthropic instrument, we started, and we are going to show the structure later, we started consulting then what's the first need. So if we have fewer resources, what should we address first? And the communities also answered that something very important for them was financial management. They said, we are producers, we are family farmers, and we need more support, actually, how we organize this and how we are going to pay back. So the first activity that we supported with the philanthropic fund was precisely to enhance their capacities, work with them, with a consultant to enhance their capacities, and so that they could pay back and organize their financial management. We have been expanding to other needs, also in the philanthropic investment, and Manuela can tell more details on that. But we are supporting, for example, now improvements in their processing units, the ones that have already processing units at the local level, how we improve that align with regenerative criteria from WBT certification that Natura uses, so they can also improve their operations in line with regenerative criteria. So this is another area that we have been working, and we are also preparing the mechanism for investment from Jeff. So we are also designing a gender strategy, and this has also been shaped together with the women in the communities. I think we can move to the next slide, and so we can talk a bit about this architecture, Tom or Claude. Yes, so here I think it's a very visual slide, and you can see where we have the donors, where we have the investors as well for the CRA. So the CRA is the credit instrument, and the ECF is the enabling conditions facility, the philanthropic fund. And yes, so we are founding members, Natura and VET and Fumbio, and we shape this. But as I said, there is a board. We also have another structure that's also informing, mostly from the communities, informing priorities and so on. And we have annual meetings with them to actually see if we are going in the right directions, make adjustments, and this annual meeting is coming up in a month from now. So I think here it's important. We had IFC joining us last October, and I said we have this upcoming investment from Jeff that is already in the final phase of approval. We have actually one, I think, of the challenges looking ahead is also how we develop this pipeline of investments. And we are also dealing at the moment in Brazil with high interest rates. So how we balance, because this is not completely subsidized as it would be from the government, but is also not a market rate in terms of interest for them. It's somewhere in between. So we are also looking at this structure and trying to accommodate in the way that is financially sustainable, also the credit, and also looking for more philanthropic investments, because we started with these partners, Good Energies and Fundo Vale. We also are partnering with IDB for a specific program to develop capacities of the youth and integrate them in the supply chains. But we are also looking for more philanthropic investments to enhance also our activities on the philanthropic fund. So it's a blended finance in the terms that we have these different investors in the credit vehicle, so with different interest rates, and Victoria can explain this better later, but also blended in the sense that we blend a philanthropic instrument and a credit instrument, providing at the same time technical assistance and credit together. You can also move to the next slide, perhaps, Claude and Tom. And here is just where we are. We are the geographical coverage, which is from the CRA, the credit instrument, but also the ECF, because we are in the same area. And I think that's the numbers we have to date. So 15 cooperatives and associations, it's around 2,500 families that are associated to these cooperatives and associations. And this is also in terms of USD, it's 2.6 million that we have provided, because we have this, and when we received it at the end of the year, we lend again. And as I said, thus far we have 0 default rate. And I think just the last slide also to show the programs and components of the ECF. Here's what I said. So we started first working with institutional strengthening. We are working now with also this regenerative practice, as I said. So they are related to improving livelihoods, but also related to having more renewable energy at this organization, so they are not relying on fossil fuels. And it's difficult also to strike this balance in the Amazon. We are starting to work with agroforestry systems. We are supporting a first project in this direction. And as I said, we are also working with women's empowerment, so to say, in the sense of the cooperatives and association, and also looking at the youth, which are very important aspects of the governance also, that we also take into account gender equity, and also how we onboard the youth to have the continuation of these supply chains. So I think in a nutshell, this is the structure and what we have done thus far. And I think we can open the floor later for questions and address your questions on more details. That's it.
Excellent, thank you, Gabriela. Apologies to all for a bit of the sound quality there. Hopefully you could follow that. Appreciate that was quite a high level. Lots more detail in the guidebook that we will be publishing, but super impressive of what you've managed to achieve in a relatively short period of time, particularly crowding in some new money, which sounds really exciting. As a reminder, if you have any questions for Gabriela or the LAM team, do use the Q&A box to post those questions, and we'll come back to them once we've heard from all of our speakers. But we're gonna move on very quickly. We're gonna get through our speakers in a timely fashion. So I want to introduce our second speaker, and that's Michael, who's going to speak to us about the Rimba Collective. So we're moving from the Amazon over to Southeast Asia. Michael, over to you.
Hi, everybody. Good afternoon. Thank you very much for having me. I'm really happy to be here and give you a little bit of a flavor about our work. Maybe I'll start a little bit with Lestari Capital and then use the Rimba Collective model as a sort of an illustration of what we do. Lestari Capital was conceptualized in 2015. And we are mostly based, we're actually headquartered in Singapore with the largest number of people in Southeast Asia, in Indonesia, across Malaysia, and Indonesia. Really, the ethos of what we do is to leverage market-based financing for financing natural capital protection and restoration. And the way that we do that is we work very closely with corporates, large corporates, to better understand what is the shareholder value, what is the business case for those investments into natural capital protection for their companies, to structure that demand, and really to build the mechanisms around it to then actually deploy the financing that results from that demand into portfolios of projects. Maybe we can go on to the next slide. The Rimba Collective is really one of our largest initiatives right now. It is capitalized at about $100 million. We started with 4 founding partners here, and we co-created this mechanism, which is doing exactly that. We understood what it is that the companies actually need, and what does the demand look like for them? How do they actually communicate this internally? To do this not at sort of philanthropy or CSR or donor-focused finance, but how to do it over a long term, I mean 25 years. How to do it so that it is linked, integrated within the business's operations, and ideally into procurement as well. But really, what is the shape of the demand as well? What does the demand actually need in order to be realized? And what I mean by that is, what is it that we're actually trying to finance? What is it that we're trying to offtake from this portfolios of projects? And so we structured that demand. We created financial mechanisms around, what that kind of initial financing would look like. How do you create equitability in such models? How do you create sustainable and viable finance over the long term, and create a business plan around that? We built the mechanism itself, which is this kind of dedicated financial platform called the Rimba Collective. This doesn't need to be complicated, by the way. You don't need very complicated financial instruments in order to achieve scale and in order to achieve impact on the ground. And we work actually 50% of Lestari Capital is focused on the projects. And so actually identifying the projects, doing the due diligence, providing technical support to the projects on the ground in order to sort of raise the level of capacity capability where they would be effectively eligible for market-based financing. And maybe this is something that we could talk about a little bit later on in the Q&A as well. I think the project supply is a really key component of this, which fundamentally needs evolution, I think would be the diplomatic way of putting it, maybe. And so the projects themselves, we don't manage the projects, we don't own the projects, they are third party to us, but we do work very closely with them. The projects are multiple typologies. In many cases, within the Rimba Collective right now, they are community forest projects, but they are linked to the production areas. So they're not producing the commodity that these companies are sourcing per se, but they are fundamentally inbuilt into the sourcing landscapes from which the commodities actually are being sourced. And that creates that natural capital in sourcing landscapes and the supply chain resilience that you need in order for that commodity to be produced over the long term. And that is a really fundamental part of the business case for these companies. The projects that are being supported all vary slightly in terms of what they do, but really the key components of what we're what we're seeking to achieve here are hectares of conservation, hectares of restoration, biodiversity protection, climate outcomes, whether it's removals or reductions, and livelihood outcomes as well. We effectively commodify those impacts. We finance the projects 100% in terms of what they need. We have long-term offtake agreements with those projects, and we retire what we called ecosystem outcomes, ecosystem service outcomes. You could call this a rudimentary nature credit, effectively. And I'm very happy to talk about that particular aspect of it in the space. The companies are then able to make claims against sustainability objectives, able to make claims against compliance requirements as well, claims against stakeholder and shareholder requirements too. So it's a relatively simple model. You could describe it as an impact sourcing mechanism, impact sourcing and offtake mechanism. I think that would do it a little bit of a injustice. The mechanism took about 18 months to develop. We funded it completely from the corporate financing, which was about $2 million in the just for the development of it. But the model is highly replicable, and it's also applicable to other commodities and other companies, and allows for shared responsibility for different supply chain tiers to enter into the Rimba Collective and help us scale it up. Maybe next slide, just in the interest of time. So what have we achieved so far? Just to give you a little bit of a flavor. So our initial ambition was to work at about 550,000 hectares. So about 500,000 hectares was the initial portfolio vision of what we were going to be financing over those 25 years. I'm really glad to say that actually this in itself, that ambition is scaling up. So we are at about 650,000 hectares right now, and we hope that we will be able to increase it to 1 million hectares over the next few years. The portfolio, of course, can't scale to that level immediately. We are now in our third year of operations, and so we are about halfway towards that target. So as of today, we are financing almost 250,000 hectares of projects across 16 projects. And we have a large pipeline that is envisioned to be coming into the portfolio, not only as we expand the portfolio to address the current contracted long-term demand, but also with new companies entering the Rimba Collective. And we've delivered around $20 million to date already to those projects. And maybe I'll just finish there and give you back some time.
Thank you, Mike. Really appreciate that. And as always, we have a short amount of time, so we're really sort of taking a high-level view of some of these models. We referenced earlier that there will be a guidebook upcoming at the end of this month, which is focusing on some of these models, which will provide a little bit more detail, but really like the simplicity of the structure of the Rimba Collective. Any questions for Mike, do put them in the Q&A, and we'll find time to come back to them at the end of our speakers. But let's move on to our next speaker.
And we're very cheap compared to a standard of scale, which is critical to the scale.
And delighted to introduce Doug, who is from Finance Earth. And Doug, you're going to tell us more about the Fisheries Improvement Fund.
Yeah, hi everyone. Yeah, we can flip to the next slide. So just briefly on who we are as Finance Earth. So we're an environmental impact investment advisor based in the UK, active in about 35 countries worldwide, and our whole mission is to facilitate more investment into nature, climate and communities. To do that, we work with a wide range of partners, some of the larger NGOs, but also a wide range of private sector companies, particularly those active in agricultural supply chains, and quite a lot of work with financial institutions as well. And we can provide both advisory services, but also where we see exciting scalable models, as is the case with our fisheries work and some of the others I can talk about in a second. We can also work with partners to actually design and launch those, and that's always, or nearly always, our aim, particularly in our work around supporting sustainability and resilience in supply chains. Can we move on? So on our Fisheries Improvement Fund, just with this loading up, so this is an initiative that we launched and designed with WWF a couple of years ago, really with the aim of supporting or enabling a more sustainable, scalable funding model for fishery improvement projects, so FIPs. These are programs to improve the sustainability of commercial fisheries worldwide. There's about 150 of them currently, but primarily they're very dependent on very ad hoc sources of funding, heavily reliant on grant funding. There are a number of companies that contribute to them, which is great, but it's very piecemeal, very reliant on company CSR sustainability budgets. And we worked with WWF to design a new mechanism that would provide a more scalable and predictable source of funding to enable these projects to ultimately reach completion in line with expectations, and typically to progress the fishery towards Marine Stewardship Council certification or a different certification. So the mechanism that we built is primarily centered on a volume-based fee contribution mechanism from supply chain companies. We piloted this in Chile, where we launched a program last year, and we worked with some of the larger buyers of, in this case, fish meal and oil that's being produced through fisheries in Chile, so in the small pelagic sector in particular. They each contribute into the Fisheries Improvement Fund through a volume-based fee structure. So the more they buy, the more they pay effectively, and it's quite transparent for them. The price per ton or per kilo, it's the same for everyone, and that was quite a strong selling point, I think, for the companies, that there was that equitability in the mechanism. And we confirm that revenue stream over a 5-year period, so it's fully contracted in. And we use that as a revenue stream against which we can then raise repayable finance. So we have a loan into the Fisheries Improvement Fund from the Walton Family Foundation initially that enables us to actually fund the program being delivered on the ground or on the water in Chile, in this case by WWF, but elsewhere it could be delivered by any number of different organizations. One of the things we were keen to achieve through the mechanism is to, and through the volume-based fee in particular, is to build the cost of some of these programs, or the cost of sustainability, if you will, into product cost and reduce reliance on CSR and sustainability budgets. And I think we've achieved that broadly through the arrangements that we have with the off-takers currently. And we review that as, we hope, a more scalable and sustainable model for these companies going forward that's less at risk of changes to companies' CSR budgets over time. It also means that we're able to fully fund the project through to completion. So there's obviously a series of KPIs that WWF would need to meet when they're delivering the program, but providing they meet those, the project stays on track, we can give them confidence that we have the funding available to fully deliver its objectives and support that fishery through to its sustainability objectives. We think it's quite a replicable model. We're working on a number of fisheries worldwide where we're also going to deploy a similar mechanism, but have also been looking in other sectors where we can take some learnings from this and apply elsewhere. Maybe we can just jump onto the next slide. And part of that has been in the UK, actually, where we've designed and launched an insetting program for UK arable farmers. So this is through work in partnership with Soil Association Exchange. So they're a leading provider of farm measurement and baselining services across a range of nature and biodiversity and social outcomes on farms here in the UK. And this mechanism really has the aim of supporting and enabling supply chain companies who are sourcing from those farms, generally a long way down the supply chain, so retailers, but also manufacturers and brands, enabling them to support farmers to reduce their greenhouse gas emissions in a structure that enables those companies to reflect that reduction within their Scope 3 greenhouse gas inventory, which is a key criteria that we had from the companies when we set out on the design process for this. So the way the mechanism works, we have secured funding from, as you can see on the right, some of the bigger UK retailers, so Tesco, Co-op, Lidl, Lloyds Bank are also a big partner. We have the Church Commissioners of England, who are a big landowner as well. they each put their funding into the central vehicle exchange market, and that vehicle then pays farmers a fixed amount, £60 per tonne CO2 equivalent of reduction in greenhouse gas emissions based on their own unique baseline, so for their specific farm. And the farmer is free to choose whatever practices they would like to do in order to reduce their greenhouse gas emissions, provided that those practices can be reflected in a tool called Farm Carbon Toolkit, which is one of the leading carbon calculators for the agricultural sector in the UK. So we effectively use that to verify and calculate all the emission reductions that would be resulting from the actions farmers undertake. Farmers receive 50% of their expected payment based on an action plan that they develop at the outset, 50% of the expected payment up front, and then the remaining 50% is received upon completion at the end of the year. They can receive payments over a number of years through this, but it's not an indefinite program. There would be a cut-off at some point as well, so it provides an endpoint for retailers and other participants around the funding that they receive. And one of the key benefits of this mechanism from the company participant perspective is that because this is an insetting program, we're able to effectively share that cost, so that's £60 per tonne, between a number of different actors who each have the same farm within their Scope 3 greenhouse gas inventory boundary. So if you think of a single farm, it might be supplying into a grain merchant, they sell to a miller, they sell to a bread manufacturer, they sell to a retailer. The farm also, of course, has a bank and a landowner, and all of those different actors will have that farm's greenhouse gas emissions within their Scope 3 inventory. And the more of those that we can bring into the mechanism, the lower the cost we can achieve for everyone in terms of price per tonne CO2, while still retaining a good high value for farmers, which, based on the analysis we undertook, is the level that we need to incentivize them and reward them for the risks ultimately they're taking in adopting some of these practice changes. It is an outcomes-based approach, which we had really good feedback on from farmers. We considered an approach where we would provide payments for specific practices, but transitioned over to an outcomes-based approach in consultation with farmers, which I think provides them with a lot more feedback and also makes the mechanism easier to administer as well. And we've also built in a mechanism through which early adopters of some of these practices that reduce emissions can also benefit through the programme, which is some feedback that we received from farmers across other schemes, that those who took action earlier can sometimes miss out on these later rewards. We've built in a mechanism that enables them to also be supported through the programme. Launched this earlier this year with £1 million initially in funding from the contributing companies, and we'll be expanding the programme during this year. Flip to the next slide. I won't go through these in detail, but just suffice to say that we're looking to deploy similar mechanisms across a range of different sectors. Each of these will be slightly different, so none will be a direct copy of either the Fisheries Improvement Fund or Exchange Market, but similar mechanisms around bringing together multiple companies with a shared interest in a particular sourcing region, particular commodity, or scaling up a particular solution or adoption of certain practices. That type of structure we think could be deployed in a range of contexts. Can we move on? And lastly, I would have to just reflect on a few lessons that we've learned through all of this. I'll just skim briefly through these. So one of the key challenges we know in engaging with supply chain companies is clearly their limited budgets, particularly in the sustainability aspect. And as I mentioned, we tried to address that through where we can, building the cost of some of these programs into the product cost, so that we can move that budget heading across into the procurement budget. Noting that obviously margins are often tight, this can be difficult to do, but as a direction of travel, we think that's a useful way to go. There's always concerns around value for money and free riders in these mechanisms. For that reason, we've tried to focus in many of these approaches on companies that are quite a long way up the value chain, so close to farmers and producers, where we have hopefully a small number of actors who are buying at scale from some of these sourcing regions. Makes it easier to engage with, and also the more we can get on board at that stage, at that point in the supply chain, the easier it is to reduce the free rider problem. We always try to align these programs with common business priorities. So, as I think was mentioned earlier, we need to deliver outcomes that are actually meaningful for companies, enable them to report the impacts as they wish. So whatever is the priority for them, commonly Scope 3 reductions, deforestation conversion free, sourcing, could be other outcomes as well, but we have to bear that in mind from the outset. Also the resilience, supply chain sustainability is increasingly coming through as an important driver for companies as well. We've been looking at more supply shed style approaches to address the limited traceability that we see in many of these complex supply chains and how we can accommodate that. And lastly, but certainly not least, is the importance of building or incorporating farmers in the design process, or producers in the design process from the outset of these mechanisms, and really designing solutions that ultimately, of course, work for them. It's no use having a solution, even a big pot of money, if we can't get farmers to take that up. So we want to co-design with them from the outset. And yeah, I'll leave it there. Welcome any questions or thoughts afterwards on that.
Super. Thank you so much, Doug. And really appreciate the demonstration of replicability, easy for me to say, of your model for different commodities. That's something we're striving to do in Revenues for Nature, is not just find successful models, but those that can be replicated in other geographies with different commodities and sectors as well. If you've got any questions for Doug, please put them in the Q&A and we will come to them after our last speaker. And on to our last speaker. I'm delighted to invite Tom Curtis to provide an overview of the Landscape Enterprise Networks, otherwise known as LENS. Over to you, Tom.
Hi, thanks so much. Thanks so much for inviting me. Fascinating and inspiring to hear the other speakers. Yeah, let's whip to the next slide. So I'm Tom Curtis. I'm director of Three Keel, which is a sustainability business based in the UK, although we operate across the world. And I'm going to talk to you about a service that we developed, which is called Landscape Enterprise Networks, LENS. And essentially, this service helps businesses to work together to fund and build resilience in the landscapes they depend on. And those companies might be food manufacturers. In our case, they could be multiple types of companies, but the ones we operate with are food companies who are interested very often in the resilience of their supply sheds, and also greenhouse gas emissions. Maybe utility companies, water companies who are interested in water quality, water quantity. It might be local government or regional government interested in flood risk management, for example, or other sectors as well, such as insurance. We're currently operating in Landscape Enterprise Networks. We started off in the UK, and I'll talk to you a bit about where we started and how we started. We're operating across Europe at the moment, but we think it's something that could be adapted and plugged into landscapes and landscape initiatives beyond Europe as well. So yeah, let's kick on to the next slide, please. LENS started out in a conversation with Nestle, the food company Nestle, about landscape-derived risk for a milk processing plant they have in the northwest of England. In essence, they source all of their milk for that factory from within a 50-mile radius, and we were having a conversation with them about the issues, the concerns they had around resilient supply into that factory, and also issues to do with flood risk management, which is affecting logistics in and out of the factory. And so we started to develop with them and through a partner, First Milk, a series of actions that farmers could take on to do with farm management and also nature-based solutions in conjunction and innovating with the farmers that would address those resilience issues for Nestle. So the first part of that, which is interesting to us and sort of sits within the LENS model, is that we're starting to look at landscape resilience from the perspective of the paying customer, if you like, which is just a pragmatic means of generating revenues to build resilience programs. The second thing, which is a key ingredient of LENS that we quickly built into what we were doing there in that landscape, was that we were already operating up there, and we knew that the water company in that region, United Utilities, had a problem with water quality in water courses, too much phosphorus. And they also had localized flooding issues for some of their infrastructure. And so what we quickly realized was that there were solutions, agricultural system solutions and nature-based solutions that could happen on the farms we were initially talking to that would actually serve as solutions for both organizations, even though each organization had a different set of problem statements. And so we were able, therefore, to get them, arrange for those organisations to pay for a series of land management practices on those farms and share the cost of that, essentially. So you had multifunctional management solutions, problem-solving solutions being co-funded by different organisations. And that's essentially how we invented Lens, was figuring out you could co-fund use customer-focused approach and also a multiple funder approach, and work with a group of farmers who would innovate a set of measures on land. So what we've done subsequently is next slide, please. Is we've turned that into a next slide. That was the last slide. Thanks. Into a repeatable and scalable system. We've systematized essentially what we learned up in northwest England. And in essence, what we do is if you look on the left-hand side of this diagram, we take different companies with different needs, use cases out of a landscape. Often different companies requiring different crops, like often arable crops, so wheat, they might or barley or oilseed rape. Or water companies or insurance companies or local government. And for each of those, we really understand their demand profile. What are the requirements? What's their problem out of that landscape? And what we do with that is we figure out where those different needs overlap in terms of solutions. So we're looking for common interest solutions. And that means technical things on the ground where there's a technical overlap and a physical overlap, where we can fix up solutions that they'll all be interested in. Essentially, all of those organisations for different reasons would pay for them, and we turn that into a demand specification, and we put that out via intermediaries to groups of farmers, and we ask them to respond with proposals and innovations that will deliver against that joint demand specification, and then we turn that into a multi-party contract. And through that and negotiate a price, negotiate a deal for that. And the advantage of that for all of those demand side players is that they're a couple of things. One, they're sharing costs, which is really critical for them. The second thing is that the solutions that we're looking at, whole farm solutions or whole landscape solutions, and usually on the demand side of this, the food manufacturers or water companies are only really able to engage in one facet of a landscape, whereas what we're doing is enabling them to put their facet into other people's facets and ask a joined up question of the farmers in that landscape and get a joined up solution. And that's really critical. If you're an off-taker only interested in one commodity crop and that's being grown in a rotation, you don't have enough of the picture to be able to really drive transformative change. Those are really important aspects. From the farmer's perspective, they're getting an investment. It's a business deal. They're getting paid for doing this, and they're getting an investment in the long-term resilience of their farm. Very often, their resilience is shared with their off-takers and the other beneficiaries of that landscape. And then we connect that deal up with a monitoring, reporting, verification system, essentially, which reports back on those multiple outcomes that the demand side are interested in, and it also reports back on the fact that the work's being done. The third thing that the MRV system does, and it's been a significant part of the investment in what we've developed, is it enables us to figure out what works. Because by looking at what's happened and building up a database of actions on the land, and looking at how they've performed in terms of resilience, carbon, nature outcomes, we can figure out what works best, and we can adaptively learn then and feed that back into subsequent trades. And so then what we do with Lens is we set up those multi-party transactions, and then we set up an increasing number of them. We accumulate a kind of web of those transactions across the landscape to deploy more funds from more companies to more farmers over time. And in the process, we build up a business community, which is a really important aspect of Lens. So next slide, please. We've been scaling up Lens. We started out in northwest England. We've now got a strong base within the east of England and Yorkshire, but then also we're operating across other countries in Europe, in northeast Italy, in Hungary, in Poland. we're developing programs now on the cusp of transactions actually up in Scotland, and developing program and in West Wales, but also in Ireland and Spain. We're starting to develop programs there as well, and in the Netherlands. And to date, we've deployed about 37 million euros direct into land management practices on farms. We're operating across about 80,000 hectares at the moment, and our kind of growth trajectory is increasing every year. Let's put it that way. It's increasing fast. We tend to find that there's a lot of demand, and there's certainly a lot of supply for this as well. And we work with a wide range of partners early on in Lens, and continuing within Lens. We've had some key partners. I mentioned Nestle, also Diageo and PepsiCo, but a very wide range of different demand side partners. I'll crack on to the next slide. So just top level stuff, a few lessons that we've learned through the development of landscape enterprise networks across Europe. It's really important to be able to be really transactional and business-like. These are multi-party transactions. We're delivering value for our demand side players, and we're doing that through really business-like and straightforward transactional relationships with our farmers. And what that does is it builds confidence in delivery and transparency around what's delivered and how and when, and that's really critical. Obviously, we have big visions about what this is all about, but actually, when it comes down to it, we need to do business. Community as well as contracts. We know that good business is done through businesses that are talking to each other, that understand each other and trust each other. And so our approach is very place-based, and supply shed based. And within those supply sheds, we very deliberately build communities of farmers who are talking to each other, innovating with each other, delivering outcomes collaboratively, but also talking to the demand side customers as well. We put them, in human contact with each other so that they can understand needs and understand solutions. Importance of the MRV system is absolutely critical. People need to know what's happening. They need to know that what they're paid for is happening. They need to know they're getting outcomes, and we need to be able to feed that back into continuous improvement in the system. Challenges, managing complexity. We just have to be really systematic. We've done around 120,000 transactions to date. That just needs a really systematic and organised approach. Aligning the demand side needs. It's complex. Can be like herding cats sometimes, but that's the nature of the game, and that's what then delivers real outcomes for companies in real landscapes that they're sourcing from, and so it comes down to specific farms that they're specifically all sourcing from or have an interest in, and that's complex, difficult to align. We have a lot of trade optimization mechanisms and tools now that we use, and so there's a challenge that we've had to build into the system. And another challenge is action learning. Actually, we've invented this by doing it, but I think that's how the others seem to have been doing their work as well. And it's the way you deliver real outcomes rather than notional outcomes, or just doing a data collection exercise and data reporting exercise. This is about real change on the ground on farms. Big unlocks for us. I think a really big part of an evolving and developing imperative for our demand side is material risk and managing material risk to their supply chains or material risk to their infrastructure. The more we're able to put numbers on that, the better. Very good at putting numbers on carbon and other aspects or things associated with resilience, but the more we can put numbers on that, the better. Weaving in government funds, that for us is an unlock. All of our money is currently private sector. Well, 98% of our money is private sector at the moment. And then we always think of Lens as one component part of a wider landscape game plan, and so for us actually plugging into and collaborating with others is an exciting prospect, because that's the route through which we'll generate genuine landscape transformation for the better, for communities and for economies. So yeah, that's Lens.
Excellent, thanks, Tom. Really appreciate that observation around the adaptability of this model and others we've heard about today to deliver on the ground what's important. We've had some great questions coming in. So yeah, thank you to the speakers. Really great insights. There has been some further detail on some of these models posted in the chat as well. So to find out more, do click on to those. But maybe we can take down the slides now and we can see some faces so we can have a conversation with the panelists, and I'm going to pick out a few of the questions that have been coming in, and do keep them coming in. We've got a bit of time to go through them. I'll start off by going in chronological order with our speakers, and Gabriella, to start off with you and the team with the Living Amazon mechanism. Some interest to find out more about the enabling conditions facility, particularly how it stimulates the supply side of investment opportunities. Now, is the ECF helping investees become investment ready? And then the second question for you, Gabriella and team, is to give a bit of insight in terms of the kinds of KPIs that you have in place, particularly for monitoring biodiversity impact. So Gabriella, I'll pass over to you, and if you want to pass on to any of your colleagues, please do so to respond to those.
Perfect. Thanks, Tom. I hope my audio is now clearer. If anyone has a problem, let me know. So I will start. I think I can hand over to Manu for more details. But basically, we have selected the consultant that had already experience working with communities for doing this capacity building in financial management. And I think this is key because many times, and this is also the feedback we have from the communities, they said the difference here is that as it's shaped together, it works. So they say it's fitting because sometimes they have this experience of consultants going to the communities and delivering a solution that's not fit for purpose, it doesn't fit the reality. So this is a thing that we learned from them. Yes, it's working. Please continue doing that. And I think also another important aspect of this is that it's not only simply a training program that they have the capacity building, go to a room and learn how to do, and it's generic. So it's really one-to-one process. It's hands-on training, so to say, that they look at their finance together, they look at their revenue, they look at their all sources of income and what they have to pay. So it's a balance sheet that they work together and see how this is looking throughout the year. And this is helping them, they also told us, even to report to their own associates and their own cooperative members. So I think this is a differential, a feature that it's working in the sense that we get the feedback and we adapt, and it's also tailor made to each cooperative. So they have different stages of development, different teams. Some of them are more technical because they have someone who has been there, for example, is hired, but most of them, they are just working from pro bono, and it's another let's say another task that they have on top of everything that they already work as farmers and plant extractivists. So I think is something that we're constantly shaping and learning if this is still fit for purpose or what they need going forward. I think that was the first question. The second question, I don't remember exactly.
What kind of KPIs do you have in place, particularly measuring
Yes.
the biodiversity outcomes?
Okay, so I think, I don't know, Manuela, if you want to add something to the capacity building, and then we go to the KPIs.
Okay, Gabi, maybe I can write here, but yes, it's important to understand that ECF is the assistant technical is directed to the communities, and they decide the priorities that are important for them, because we don't have money for everything, for every. Yes, but we decide with them, and now we are we are working with them in the management, improving the management, and yes, and to improve the productivity of the agro productions, and and um, and and we are started to work with gender um, gender questions, uh, gender feminism, yes, and the leadership. So we are trying to prepare them for access another credits, bank credits, bank loans, and to be prepared to supply the market, every market, not only Natura, but other off takers that they can demand. Yes. This is our focus. And about outcomes monitoring biodiversity, we are monitoring this impact positive. We are developing our questionnaires. We developing safeguards mechanisms, but we are still we still developing this the monitoring.
Okay, super.
That's it.
All right. So we'll
Shall I
find out.
just- Yes.
We'll find out
Shall I-
more about the monitoring in the near future.
Shall I just add one short answer here? Natura has a commitment, a public commitment to help protect or restore 3 million hectares of forest. And we are also saying exactly this because there is a monitoring system around this and how we calculate how, because it's also that they are not, especially the plant extractivists, they are going to a wider area and they are extracting from standing forests. And we are using the same metrics. Actually, we are based on Natura, and when we expand to other supply chains, we are going to attach to something else. So currently, the ones that we are supporting, so it's a contribution. I think that's the important part. It's a contribution because we are contributing to this business to remain living from either restoration or protecting standing forests. And we calculate it's around 2 million hectares currently, the ones that we are supporting, the area that's covering. And there is a paper on that, on the methodology and comparing where Natura is present to other communities and showing that there is a larger forest cover on where Natura is working. Sorry.
Excellent. Thank you, Gabriela. Thank you, Manuel. I appreciate that. Doug, I wanted to turn to you and a question we had here about the exchange market structure that you shared, and the question being, is the fund a feeder vehicle, an endowment fund, or is it a spend down fund, and how would you ensure the durability of these efforts?
So yeah, you could think of it as a spend down fund. So we did look at models where we would instead lend to farmers, but effectively concluded that that wouldn't be an attractive proposition in many cases for various reasons. So in terms of the durability, obviously our intention and aim is that we can bring more funding into the mechanism over time, and farmers will be able to receive payments for a number of years through the program, but not indefinitely. So for participating businesses, there is effectively an end point in sight, and the intention overall is that by supporting farmers for a number of years to make a transition to effectively lower carbon practices or more regenerative practices, we can demonstrate that it's possible to do that in a way that ultimately enables them to maintain or increase their levels of profitability, and therefore there's no need for an ongoing indefinite subsidy, if that makes sense.
Yeah, no, perfect sense. Thank you, Doug. Appreciate that. Tom, coming to you related to Lens. So couple of questions here. Are you securitizing the network contract so that you have upfront capital for farmers? How is the network funded? And the second question, and maybe actually to open this out to other speakers as well. So does the need for the lens model indicate a regulatory failure? Companies are making payments because farming impacts are not regulated, and maybe broadening out that question to others to think about, if you like, the regulatory impact or implications, an evolving regulatory environment, how that is hindering or helping to progress, etc. So I wonder if there's any broader reflect regulatory environment on some of these models we've heard about. But Tom, to you first on securitizing the network contracts, and then what's your perspective on whether lens is indicating a regulatory failure?
I probably won't provide totally satisfactory answers on either of those, but in terms of the payments, I mean, they're straightforward contracts which pay out as measures are delivered on the ground, essentially, and those contracts can be 1, 3, 4, 5 years long. Some of them are 10 years long, and essentially they get staged payments, and largely there's not large amounts of capital required up front for most of what we're doing. A lot of it's shifting and agronomy. Some of them are capital requiring capital up front, and essentially the payments through the contracts are staged in order to not expose the farmers and to ensure they're getting paid. It's just they're straightforward operational contracts in many respects. So I think I don't know if that answers that question. It's they reflect the nature of delivery and are staged accordingly, and negotiated accordingly, and it depends on what's being done. But important to realise that an awful lot of this is agronomy, which is happening on a year-on-year basis, essentially. In terms of regulatory failure, I guess so, perhaps to some extent, but at the same time, these are just material risks that are required that are appearing in supply chains that are to some extent international. There are biophysical, trade, geopolitical risks that are impinging on lots of businesses across multiple marketplaces, and I think that our businesses are responding to that. Now, is that a failure of regulation? Well, you could say it's a failure of global governance and geopolitics in a sense, or the issue of climate change more generally. And but the pragmatics are that people have to organise, get together, and do something about it. Now, does that mean that regulation is irrelevant? Of course it doesn't. Regulation is really, really important and really useful. And I think in our instances, we're working in conjunction with legislation, and as much as possible trying to align with and work in conjunction with public sector to grants if we could and can. So I think there's always a possibility for evolution, but I think what we're looking at here are emerging existential risks to food supply chains, essentially, and these are practical responses to it. So I guess I wouldn't frame it primarily as a response to regulatory failure.
Great, thank you, Tom. And Doug, Gabriella, Michael, I don't know if you wanted to come here about how sort of regulatory factors have implications on your respective models, whether that's regulatory change or regulatory gaps, for example. Is it a big issue that is factored into your models? Any of you want to come in, Mike?
I mean, I can do it maybe from a slightly different angle, I would say. I mean, I think we're constantly interested in what are the drivers, right? What are the drivers to actually finance natural capital? And regulation, would have a very fundamental place in that, right? If the regulation that is being developed is aligned with exactly that, right? I mean, our interest is to finance natural capital protection and restoration in sourcing regions, right? And actually, I would like to go one step further than that and say that we should be financing conservation also outside of supply bases, because where we are mostly focused, which is the global south, that is really where you get the biggest bang for your buck, right? In terms of intact forest protection, or even good secondary forest protection, something which might actually be more remote than what could be considered to be a supply shed. But of course, what is not a supply shed today doesn't mean it won't be a supply shed tomorrow. Just look at Kalimantan, what it looked like 30 years ago. And so, we need to be sending the right signals to those areas, that actually there is revenue, there is finance there is money to be made from conservation rather than exploitation. And that will really, in my view, in my humble opinion, that could really transform the world. And I don't think that regulation is there yet on that side of things. Where regulation is moving towards is conservation of natural capital and restoration, definitely on farm, so to speak, in the production areas. I think in some cases it is moving towards identifying your risks and under things like the CSRD, and even TNFD, which of course is still voluntary, but it's still, I think there is a convergence of these regulatory systems moving, happening, that you are looking at your risks and opportunities, and clearly your risks from natural capital degradation and destruction is one of the key things that you have to identify. Your scope 3 emissions are probably 80% coming from those areas if you're an agricultural dependent company, and I think we need to align the opportunities side of things better to make it really explicit that actually natural capital protection and restoration is what is needed as an opportunity on that side of things. So no, it's not a perfect fit. I don't think the regulatory development right now, is it heading in that direction? I think so. There are now sort of more delays and more reframings happening in the EU, which is still leading on this, by the way, I think, in my opinion. Those delays are happening, but I think the trajectory is there. And I think quite a lot of the companies are understanding that trajectory is also there. It's just a matter of when it will happen rather than if.
Great. Thank you, Mike. Appreciate that. And maybe that's also a nice segue from sort of compliance and regulations into sort of the more voluntary space, particularly for corporate action. More and more corporate setting science-based targets, for example. We are seeing the increasing interest and adoption of insetting practices, which we've heard about implicitly and explicitly through today's presentation. So maybe particularly looking at you, Mike, Tom, and Doug, on insetting, and a couple of things here. One, would love to put one of you on the spot to give a nice succinct definition of insetting, so the audience can really understand what that terminology means, because I think we're going to hear and see a lot more of it in the future. But then also be interesting to hear some of the challenges you've observe around insetting, whether it's to do with boundaries, making claims. Now, we heard about supply sheds from you, Mike. How do you allocate benefits fairly across value chains when it's the scope 3 of a number of different corporates, for example? So it'd be great if one of you or all of you wanted to say, well, this is insetting, this is what it is, and then just highlight some of the key challenges that you see in terms of mainstreaming insetting and scaling it up as an approach. So who wants to jump in first?
Happy to start on this, but others can come in as well. So in terms of definition of insetting, I don't think there is actually one perfect definition. There's quite a few slightly different interpretations out there. I mean, at a high level, broadly speaking, insetting would be taking actions and generally paying for them that will reduce greenhouse gas emissions within your own scope 3 inventory, so within your own supply chains, as opposed to offsetting, where does what it says on the tin. You're effectively offsetting those emissions by paying for actions that will sequester or avoid emissions totally separately, with no relevance to your own supply chain necessarily. With regard to challenges with insetting, I think you touched on some of the main ones there, Tom. So there are a number of these. So one would be around traceability. So obviously taking action within your own supply chain is much easier where you have that good level of traceability down to the individual farms or producers, and different supply chains vary wildly in this. If you look at dairy in the UK, it's relatively short chains. It's quite straightforward for a company to identify the farmers it's sourcing from potentially. Other more globally traded commodities is near impossible for them. Even a tier 2, 3 supplier might not know the ultimate source of the commodity that they're supplying in. And obviously all of that creates challenges around where to direct a company's investment. There's obviously a risk they end up paying for something that ultimately their own competitors might also benefit from if they were to go looking into the emissions footprint coming out of a certain sourcing region. and practical difficulties around where to actually direct the funding as well. All of that then leads to challenges, again, around allocation. So if you fund a set of activities in a landscape, obviously a range of companies and contributors or non-contributors will benefit from that. In some cases, multiple companies can report those same benefits quite credibly. Obviously, scope 3 emissions are by their nature shared between multiple actors in a vertical supply chain, as well as things like banks and landowners as well. But where you have peers who are contributing, like 2 retailers, 2 bread manufacturers, for example, into a single insetting program, you have to be much more careful then around how you allocate up those emissions and try and emissions reductions and try and avoid any issues around double counting there. And I guess the last obvious challenge with insetting is where to find the budget for that. So it's all very well investing in your own supply chain, and there's a lot of benefits to companies of doing it in that you effectively can shore up your own supply base as opposed to offsetting, which is completely separate. But it is challenging to find the budget for that. Your margins are often very tight through different levels within supply chains. And if you look at separate sources of budget around more sustainability pots in general, again, those tend to be quite limited or could be focused on a whole range of different priorities as well. So yeah, a number of areas, but yeah, welcome contributions from others as well.
Yeah, super good. I really appreciate that sort of high-level overview. Tom, do you want to come in?
Sure thing, yeah, and Doug, thanks so much for coming in with the definition there. It was brilliant, succinct, and saved us having to do it. So it's great. I won't try and elaborate on that. Just to add, I think sentiment that we get is yeah, absolutely there are those challenges of allocation and traceability, but the big benefit of doing stuff within supply chain and that's directly relevant to supply chains or to other businesses who don't have a supply chain but have an interest in that landscape is that essentially it's building other aspects of material resilience for them. It's shoring up, as Doug said, their business operations. And in our analysis of evolving sentiment, that's a really, really critical driver and a really critical underpinning of where these marketplaces are going to go. They're partly about compliance, aren't they? And they're driven by that. But they're wanting carbon with benefits. They're wanting to know that they're getting an increasingly resilient supply shed because they're uncertain about that and they've got questions about that, and their investors might have questions about that. So to me, that's the really critical thing, is that we don't just play a carbon game or a biodiversity game, we're playing material resilience game as well. I think that's really important for future-proofing what we're all trying to achieve.
Great, thanks, Tom. Mike, do you want to come in?
Yeah, just maybe just a little bit of an additional. I mean, in terms of the definitions, yeah, we conducted our own survey of this and found 13 separate definitions, right, of what insetting could be, and so this is that sort of fragmentation is not very helpful, I guess. But I also would say one additional point, I think, to what the other 2 speakers have said is that there does need to be some level of pragmatism here, right? I mean, if we're talking about certainly, if we're talking about what are the different impacts, are we talking about socioeconomic impacts in terms of what is within value chain? Are we talking about biodiversity? Are we talking about water? Are we talking about climate? all of these would have potentially different definitions and different scales of impacts and impacts on different things. However, the one thing, and that's a rather obvious point to make, that if you really want to make this scientific, you could really go down major rabbit holes in having a really kind of science-based definition developed. But actually, the problems are, number one, as was already mentioned, the traceability to the ground isn't necessarily always there. But secondly, also, the supply chains are dynamic, right? I mean, they shift over time. And so if you're trying to do an intervention somewhere in your sourcing base, well, if your supply chain is dynamic, that within value chain, that insetting definition is slightly useless, because then the intervention would also have to shift every single time that your supply chain shift. And so, if we're talking about, for example, palm oil, where the sourcing contracts from the mills might be 6 months, that doesn't actually allow you to create interventions that are long lasting and that are actually going to make the change on the ground that you need, right? No project, no intervention can just be dependent on 6 month financing. And another aspect of this is the fact that really we're not going to achieve where we need to go without some sort of a collective action effort here. And the collective action is a structural necessity to achieve the impacts and the transformation on the ground. Now, what do you do in such a situation where you have multiple companies saying, okay, well, we will do collective action, but then they can't make claims if they shift from one mill to another. They can't then make claims on what is within value chain. If 3 of those companies source from a particular mill, but not the third company, not the fourth company, and so on and so forth, and over time it shifts. So we really have to be pragmatic and keep in mind what is it that we're actually trying to achieve here on the ground, real impact rather than definitions, and really sort of just sort of intellectual, water treading, I think in many cases. Leonard, let's start somewhere, let's move forward, but realize that actually what we're trying to do, define what we're trying to achieve in the first place, rather than the definition of insetting.
Yeah, great points, Mike. Where this really becomes challenging is on one side, the terminology and the criteria for these kinds of approaches becomes, codified in particular standards, for example, right? But as you're suggesting, that's not always based on practically what works on the ground, and there's always unintended consequences that arise as well. Last comment on this, I do want to invite Victoria in. I think you wanted to come in on this insetting point.
Yeah, so what we've been doing at the Living Amazon mechanism is blending traditional finance as well. So what we are aiming to do is like having the capital markets acting as he usually does, but with a little bit difference in the interest rates, right? So from the blended finance point of view, what we think we have to blend is actually traditional finance as well, because if you don't, you cannot scale up. So the thing we are aiming to do is like bringing both mechanisms, so the enabling conditions fund as well as traditional finance. And I think that's really important from the supply chain point of view as well, because then you start to bring more suppliers into the mechanism without having to have only the big ones, right? So that's like maybe a different point of view. And from the regulatory point of view, just getting back one question ago, I think we still have a huge gap between traditional finance and blended finance. So from the traditional finance point of view, you don't have to talk about any kind of impact of who benefits from it. And when we start looking into sustainable finance, we have a huge load of requirements that we need to do for compliance, etc. And I think it's really important to start to have the traditional finance also having to report what's been doing, because otherwise you get a lot of work and even a higher interest rate if you think about, because someone has to pay for all the reporting that you're doing. So I think that that's also something that from the regulatory point of view, it helps a lot to bridge the gap between the two sort of financing.
Great, thank you, Victoria. Appreciate that intervention. We're running close to time. I do have 2 quick questions for the panelists if they want to come back with some short answers. First one, this is all about private sector supply chains. We've heard about, from a couple of the cases, this shift from finance coming from CSR budgets, sustainability budgets, to more operational cost centers like procurement. We're hearing how business is really valuing these interventions. Resilience is really important to drive their engagement. Heard about the importance of particularly pre-competitive collective action. Be keen to hear from any of the speakers about what else do we need to see from the private sector to really scale these models? What else do we need them to do? And then the second question I had was about replicability. We had a great question from one of the attendees about the Okavango Delta. I mean, if anybody's got some ideas for that, then great. But more broadly about replicability, what are you looking when you're assessing how your model could be replicated in different locations? You know, what's the critical one or two things? So what do we need more from the private sector, and what do you look at as it relates to replicability? Who wants to take that, and quick short answers if possible?
Happy to start on the first one of those, then hand over to someone else for the others. So in terms of what we need from private sector, I think maybe one point would be around a sustained commitment to a landscape over multiple years. And we need to be cognizant that sourcing does change over time, sometimes within a landscape, sometimes between landscapes. But ultimately, if you want to achieve change within a landscape, one way or another, you need a sustained commitment to at least funding or paying for the outcomes from some of these activities, even if your actual sourcing might shift to from it multiple times during that period. I think that's one key point. And perhaps the other, I think which was touched on earlier as well, is just around understanding around the balance between, yes, you need a robust monitoring, reporting, verification system, but ultimately that that does cost money as well, and there needs to be a degree of pragmatism around what's possible versus the cost of that, and finding a solution that maybe it's not perfect, but is it good enough, and does it mean that ultimately then there's more funding available to channel to actually doing the good work that we all want to see.
Excellent, thank you, Doug. Tom?
Yeah. I mean, I'd agree with both of those, Doug. Absolutely. And I guess the other thing is it what we need from them? It's a conversation we need to have with the private sector, and our client base is about working with them to understand and put numbers on risk, put numbers on the material risk that they have from not taking this action within the landscapes that matter to them. I think that to me is an important unlock. But it's something I think we work with. We achieve in partnership with private sector as opposed to just demanding it from them. And then in terms of replicability, what we look for in the lens model is essentially are there more than are there multiple demand side interests who have a material interest in a place, and if there are. And there are solutions around that, then we can help them to work together essentially, and that's where it comes down to. That's how we select the landscapes we go into. Is you've got more than one big player. They've got a problem in a landscape, and we can help them solve it.
Yeah, I mean, you do often hear, unfortunately, of so many models that build themselves up and they realize that the demand is not actually there, right? So starting off with is there demand is absolutely critical. Look, we're just about at time. I think we have one or two slides that we want to share just before we close off. But as we transition to those slides, again, special thank you to all of our speakers today. Appreciate we could have spent a lot more time going into these models. Gave a great overview, great focus on lessons learned and how we can better work with and leverage private sector. These models and more are going to be in a guidebook. You see on the right side there, investments in corporate supply chains for nature, growth and resilience. This is going to be published towards the end of this month. So do look out for that. These models that you've heard about today will be explained in more detail. I do go for the Revenues for Nature website. We've got a series of guidebooks that have already been published. We'll have the Living Amazon mechanism out later this week and much more to come. With that, I will close off. We will circulate the slides and the recordings and the link to the Living Amazon Mechanism Guidebook in the coming couple of days. Thank you to all of our speakers. Thank you to all the participants for your questions, and look forward to connecting with you all again soon. So take care, and we'll see you again soon. Bye-bye.
Thank you.
Thanks.
Bye.